Welcome back to Wealth Path. In this video, we're exploring two of the most popular ways to invest: mutual funds and ETFs, exchange-traded funds. Both provide diversified exposure to a wide range of assets, but they differ in how they're structured, traded, and taxed. By the end of this video, you'll understand the key differences and know how to choose which is right for your portfolio. Let's jump in. First, let's talk about mutual funds. A mutual fund pools money from multiple investors to create a diversified portfolio of stocks, bonds, or other securities. This fund is professionally managed, and the goal is to provide investors with broad exposure while reducing the risks of investing in individual stocks or bonds. Some well-known companies that offer mutual funds include Vanguard, Fidelity Investments, T. Rowe Price, and American Funds. Each of these firms has a wide range of mutual funds available, from index funds that track the market to actively managed funds where managers aim to outperform specific benchmarks. An important aspect of mutual funds is that they are priced only once per day, at the market's close. This fixed pricing schedule differentiates them from ETFs, which we'll discuss next. Now, let's look at ETFs, or exchange-traded funds. Like mutual funds, ETFs invest in a collection of assets, but they're designed to be traded on stock exchanges. This means their price fluctuates throughout the day based on supply and demand, similar to individual stocks. ETFs are often created by large financial firms, including BlackRock, which offers iShares ETFs, such as IVV, which tracks the S&P 500 index, State Street Global Advisors, known for SPDR or Standard & Poor's Depository Receipts, ETFs, such as SPY, and Vanguard. Each of these companies provides ETFs that track specific indices, like the S&P 500, or focus on sectors, commodities, or themes. This intraday trading flexibility makes ETFs appealing for investors who want more control over when they buy and sell, allowing for a level of real-time strategy that isn't available with mutual funds. Now, key differences between mutual funds and ETFs. 1. Trading flexibility. Mutual funds are priced once daily, while ETFs can be traded throughout the day at current market prices. 2. Management style. Many mutual funds are actively managed, with managers selecting securities to try to beat the market, which can lead to higher fees. In contrast, most ETFs are passively managed, tracking a specific index and keeping costs lower. 3. Minimum investment requirements. Mutual funds often have minimum investments, sometimes $1,000 or more, while ETFs can generally be bought by the share, making them more accessible. 4. Tax efficiency. ETFs are typically more tax efficient, which we'll cover in detail later in this video. 5. Liquidity considerations. Traditional open-end mutual funds allow investors to redeem shares directly with the fund, but closed-end funds and interval funds are less flexible, with limited redemption options. For example, interval funds offer periodic redemption windows, generally every 3, 6, or 12 months, during which investors can redeem a limited portion of their shares at net asset value, NAV. Each redemption window allows the fund to repurchase between 5% to 25% of outstanding shares. Thus, once you invest your money in these mutual funds, it does not allow immediate flexible redemption, and it is most suitable for long-term investment. For ETFs, liquidity is high because they're traded on an exchange, making them more accessible when you need to sell. Now, tax efficiency. The difference between ETFs and mutual funds. Tax efficiency is a key distinction between ETFs and mutual funds, and here's why it matters for your returns. 1. Capital gains distributions. Both mutual funds and ETFs invest in various assets, but mutual funds often incur capital gains taxes when fund managers buy or sell securities within the fund. These gains are then distributed to all shareholders, and you may owe taxes on them, even if you haven't sold any shares yourself. 2. In-kind creation and redemption in ETFs. ETFs, however, use a unique, in-kind, creation and redemption process. Instead of selling assets to meet investor redemptions, ETF managers can exchange shares for a basket of assets, avoiding taxable events. This structure allows ETFs to defer capital gains, meaning you're generally only taxed when you decide to sell your ETF shares. This structural difference makes ETFs more tax efficient over time, especially for investors in taxable accounts. In contrast, mutual funds, especially actively managed ones, may distribute capital gains annually, which can eat into your net returns. Now, to apply everything we've discussed, how to choose between mutual funds and ETFs. When deciding between mutual funds and ETFs, here are a few factors to consider. 1. Investment goals. If you're aiming for market-beating returns and are comfortable with higher fees, an actively managed mutual fund from a reputable firm may be worth considering. But if you prefer lower costs and market-matching returns, ETFs could be a better fit. 2. Trading style. ETFs allow you to trade throughout the day, making them suitable for investors who want real-time control. If you are the type of investor who would like to have direct and immediate control of your money, this may be the better option for you. Mutual funds, on the other hand, with once-daily pricing, work well for long-term, buy-and-hold strategies. Tax efficiency. ETF structure makes them more tax-efficient, especially for taxable accounts. Mutual funds, which may have annual capital gains distributions, are often better suited for tax-advantaged accounts like IRAs or 401ks. 4. Liquidity and redemption. Consider liquidity as well. If you need easy access to your funds, traditional open-end mutual funds or ETFs are flexible options. For closed-end funds or interval funds, redemption options may be limited, making them less ideal if you require immediate access to your money. To wrap up, mutual funds and ETFs are both powerful tools for building a diversified portfolio, but they have some important differences. Trading flexibility. ETFs trade throughout the day. Mutual funds priced once daily. Management style. ETFs are often passively managed, thus lower management fees, while mutual funds are typically actively managed, thus higher fees. Minimum investment requirements. ETFs usually lower entry points than mutual funds. Tax efficiency. ETFs often more tax efficient and thus more suitable for taxable accounts. Finally, liquidity considerations. ETFs generally more liquid. Closed-end, interval funds have limited, restricted redemption schedule. Your choice will depend on your goals, trading preferences, and the type of account you're investing through. In our next video, we'll explore real estate as an investment. Unlike stocks and bonds, real estate involves tangible assets, and it offers unique benefits, like passive rental income and potential property appreciation. Real estate can also serve as a hedge against inflation, making it a distinct and versatile addition to an investment portfolio. Don't forget to subscribe to WealthPath and hit the notification bell so you won't miss it. Thanks for watching.